All right, welcome back to the Ameritrade Network. I'm Oliver Rennick. Let's bring in our guests on our panel today. We have Scott Bauer, the CEO of Prosper Trading Academy. Scott, always great to have you here in studio.
Great to be here.
Always great to have you on the screen too, but I like it when you're here. We've also got Nick Theodorakis joining, Financial Risk Management Director at TD, and Scott Connor, host of Virtual Trade. Scott Bauer, let's talk about the bond stuff first, because again, on kind of a sleepy day overall, not a lot of direction for equities, bouncing negative, positive. Bonds quickly found direction once again, and they rallied once again.
Yeah, they did. I mean, that's the easy trade right now, and that's the, I don't want to call it the scared trade, but that kind of is. And you know, people looking to either protect themselves in the marketplace or maybe play a little catch up, that's what they're running to right now. Personally, and I've been eating a little crow on this recently, I think it's, you know, too far.
Okay. Well, now, yesterday it looked like, if we see the chart right there, right, we dipped at the end. For futures, thought maybe, all right, that was the top, and then we came right back and we're basically where we were at that point yesterday. The narrative out here is basically, look, this is telling us something very dire. I tend to kind of err on that side where, look, there's clearly a breakdown between what these traders in bonds think is going to happen to the economy and what the Fed is feeling confident in.
No question about it. And at some point, something's got to break. Either the Fed is just going to come out and say, all right, you know, you guys are right. Things are really, you know, much poorer than we see them. Or on the other side, traders and the rest of the market is going to say, you know what, we really overdid this. Now we've got some catch up.
Yeah. The bonds are smarter than stocks. I've never really been a big fan of. You know, there's that phrase. But then now it's like, in addition to that is, you know, now the New York Times has a story today. And I kind of joke as a journalist, like when the Times starts doing the business stories, it's probably peaked out.
Yeah, that's like when you grab an Uber or hop in a cab and you know, the person that's driving is all of a sudden asking you about which stock to get into.
Yeah.
It's, you know, kind of the same kind of theory there.
Right. So now we've got headline stories from the Times about bonds telling us something worrisome. To me, even though I do kind of find that as a signal, okay, maybe this narrative has gotten carried away a little bit, we can't ignore it either, right? Because now you've got pretty deep inversion of the yield curve. You have something happening here that has to be resolved. And where other parts of the market have to get in line with that is the big question. Today we heard from Clarida. What do you think of what he said?
I mean, I pretty much am in the same camp, to be quite honest. You know, to me, unless there's something hidden, the numbers aren't out there yet suggesting that things are dire, suggesting that things are necessarily, you know, they're not robust, but they're not slowing down either. So maybe the big question out there, maybe the reason that we're seeing the spike up and rates falling is because where else do you go in the world if you want to park your money? You're getting negative rates elsewhere. So to me, maybe that's it. Maybe it's not as much as what is going on domestically here, what's going on with our economy, with GDP, CPI, everything, as much as it is, okay, you can't go to Germany, you can't go to Italy, can't even go to Japan or elsewhere. So, you know, maybe that's what it is.
We're looking at the quote from Rich Clarida right here from today. It's a pretty meaty one, but the message is the economy is in a good place right now. If it deteriorates meaningfully, that's when they'd start thinking about a cut. But he doesn't see that happening. So we still are stuck with this awkward moment in markets.
I think it's an important quote, right? Because going into today, we saw some weaker numbers. We've seen some pretty bad PMI numbers, you know, over the last few reports. There's some differing inflation numbers out there. I think Scott makes a really good point. There's still nowhere else to go, right? If you're not in U.S. dollar and you're not buying securities in the U.S., where are you going to put your money, right? There's negative yields around the world again, and so there's this sort of this sort of imbalance of where you can go versus what the yields are. But he's saying today that Richard said today that we look good going forward because there's been weakness in numbers, you know, in the U.S. right over the last few
doubt about it.
PMI being probably the biggest one. GDP looked pretty good today, right? But those things are all backward looking, and we're all sitting here wondering, well, the bond market says it's getting worse every day this week. The bond market says it's getting worse and worse and worse. He says today that's not the case. So what they're looking at is, you know, the go forward picture isn't quite that bad. So I agree. I don't see how this sort of yields a 3 rate cut environment unless something dramatically changes.
Right.
And I don't think they're not going to cut. Right. They're not going to cut to just bring the yield curve back in line. I mean, that could be some of what's driving, but they're not going to do that just to bring the yield curve back in line.
Esther says that's bad policy in her quote. The other thing I was going to say, to your point on economic data, we keep getting lower and lower yields. But yesterday we had a pretty ugly mortgage print, and if low yields can't do it, what can?
Well, you've got people maybe starting to get scared to spend money a little bit. Although, those consumer confidence numbers haven't really shown that yet. But, I mean, listen, if you're in a mortgage anywhere and you haven't remortgaged in the last 6 months even, let alone year, 2 years, how can you not? It's free money.
Get with it, pal.
It's free money.
Free money.
Yeah.
It's free money. But then you think about it, okay, why aren't people remortgaging? Why aren't the mortgage markets going off to the races like they were, 8, 10 years ago?
Just today, right? So since 2015, we haven't really hit a 30-year mortgage low until today, right? So, stock market rallied back a little bit today. Call it basically flat, right? S&P up like 8, right? But we haven't seen new low mortgage rates, even with this really softening, yield curve in the bid and bonds, until like literally right now. Right? Mortgage rates are below 4% as of today. So I bet if we hang here for a little bit,
They've been going lower.
but there hasn't been, I think to Scott's point, there hasn't been a reason to jump and refinance because there hasn't been new lows. But today's kind of that point. So if we see a little bit of a tick down from here, I bet you will see a pickup in
You gonna call your broker?
Yeah, I've been a 30-year bid for 5 years. I haven't quite gotten there, but it's
And here's something,
almost.
I hate to rain on everybody's Fed parade here, but as an investor, why should I care? Seriously, why should I care? Because here's the deal. Think of what, the Fed is what? It's a group of people with opinions. They say that they're data dependent, but it is, we heard one Fed governor today, we'll hear someone else the next week, it'll be one against the other. And from a long-term perspective for an investor, I think there's a lot of frustration with what the Fed says. I think the focus is more on what does the Fed actually do, right? And we're going to continue to get to this, and as investors, we need to just filter through all of this information. But I'll give you one example. I know today's focus was on the GDP revision for Q1. 3.1, pretty solid number considering where we were. Remember, now again, think about this for a minute. What was the Atlanta Fed flashing about Q1 just 3 or 4 months ago?
Right.
0.5?
Yeah.
0.2, I think, is where they stopped revising down. Now, how can someone with that much data and that much information be that wrong?
The reputation kind of precedes them here.
Well, so as
always,
yeah, but as an investor, isn't that frustrating to you?
Yeah.
To say, listen, I've listened to this rhetoric for so long.
Now you got JP Morgan
and they were so wrong.
Yep, they're both the big banks have cut their estimates.
Right.
JP, Goldman.
So I'm going to focus as an investor on what do they actually do. I'm going to just stop listening to what they're saying. What are they actually doing? And right now they're not doing much. Again, we're focused on December, but unless they do anything again, I'll just sit back and say, well, see, again, why did I listen to all this rhetoric? Because it didn't really help me as an investor.
Okay. Does it help though if there is a forward-looking? We know stocks at least are forward-looking, right? And how forward we get to December, I think, becomes this is why we think about this language and why we try and make sense of what might happen. Because even though we're still 7 months out from this, right? At a certain point, if the message doesn't line up with the market's expectation, that's gotta create something, right? There's got to be either volatility. There's got to be, I don't know where it'll come from. I don't know if it's stocks negative. I don't know if it's bonds, whatever it may be. But that's going to have to resolve itself in some ways.
So let me ask something, and this is for everybody. If we're sitting here Thanksgiving time, and the S&P's sitting right here, 2,800-ish, okay? Rates haven't moved yet. We've gotten through the next 2 earnings cycles with the market in the same place. We've gotten through 6 more months or 5 more months of tariff deliberations, and who knows whether there's going to be any sort of resolution by then. What does the Fed do then?
Inflation holds?
Everything else status quo.
Seems like they've told us they're not going to do anything.
I think there's no change.
Right.
So the opinion of these people that are on the Fed Board of Governors, like you said, Scott, they're opinions of people, but collectively, I can't think of a time in my adult life, especially in my trading career, where they have erred, where they have actually gone wrong. Now it's questionable, maybe the hikes going into December of last year, maybe that was. So for me as an investor, as a trader, and someone in this marketplace, I do have to place a little trust and a little credence in their outlook.
I'm with you on that, where you have to basically just assume when they say data dependent, that's what they mean. Because if you didn't believe it at the end of last year and you thought they were going to kill that December hike because markets are getting choppy, well, guess what? you had a pretty ugly December when they chose to go through with it anyway because they said they had told us, look, unless there's a big change in our inflation numbers, this is what we're going to do.
And I agree. You don't want to fight the Fed. Obviously, that's something that in long-term trends, when the interest rates or the Fed funds are moving higher or lower, again, you have to account that as someone who's the steward of their portfolio to say, listen, is this a risk-on or risk-off environment? But all the chop in between is what I'm saying is what people are getting frustrated with. And right now, interest rates are sitting flat, and the Fed's not really giving us much indication of either movement up or down.
Yeah, a lot more exciting is going to be Uber earnings here about to drop. I'm pretty pumped. You pumped, Scott?
I got to grab one in about 25 minutes. So
All
yeah.
right, there we go. We got to let you go, at least for now. Nick Dieterakis, Scott Connor, and Scott Bauer from Prosper Trading Academy. We got a lot of earnings that are on the way. We're going to check in with Nicole from the NASDAQ in just a sec. We're going to talk about that latest threat to the tariff war, the rare minerals, the things that you need for all the cool futuristic stuff that might get held back, but doesn't really matter. There's a few ways to trade that story. We're going to talk that. Then we're going to hit Uber. Don't forget Costco. Don't forget Gap. And then if you're a cloud service junkie like I am, Okta's after the bell too.